Wall Street is worried about the impact of tariffs, but many companies beat earnings estimates in the second quarter for a second straight reporting period. Our next guest is bullish heading into the forthcoming earnings season. What about stocks, though? Will they hold up? Let's get more from Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, great to see you. Thanks for giving us the time.
Thanks, Andy.
So it is interesting. I mean, despite the tariffs and the disruption and the fears, not a huge impact on corporate profits yet.
Not at all. In fact, just the opposite. Corporate profits have exceeded the estimates for the first and second quarter. And so there is a major gap because all things equal, if you beat the first and second quarter, the analysts should have raised their numbers for the full year by the magnitude of the beats. But because of the uncertainty tariffs coming out of the first quarter, Wall Street actually cut their full year numbers. So you have a major gap between what Wall Street was expecting and what's happened the first half of the year. Now we could have a earnings collapse in the second half and then Wall Street will be validated. But if not, Wall Street will have to chase their estimates higher into the second half of the year. The last time this happened, Andy, was COVID. You may recall that in 2020, companies withdrew guidance in the spring. They didn't know what was going to happen with COVID. Wall Street cut their estimates. The economy didn't collapse nearly as much. And Wall Street spent the rest of 2020 raising their outlook for the year. And it turned out to be a much better year than what people expected.
I want you to do a sad shake of your head here, because I think that's your reaction when you hear people say, oh, the market's overvalued.
Well, that's okay, Andy. Please, the next time someone comes on your show and says the market is overvalued or undervalued or our stock's undervalued, the biggest flaw I see of investing is that when we look at valuation, we're looking forward, never back. Stocks only care about what's going to happen in the future, not the past. And therefore, if they're looking at, say, a PE, where they take the price and they divide by an earnings estimate, that is someone's estimate. And the dirty secret is a lot of times they're not right. So my request to you, Andy, is next time someone comes on the show and says, well, the market's overvalued, say, now whose estimate is that you're using? And what's their track record of being accurate? And I think the reality is that the market, yes, this S&P is trading at 22 times forward earnings. But for the reasons I've already articulated, the E is too low. And it's going to go up. So the market might not be nearly as expensive people expect because Wall Street has underestimated the outcomes of what's going on with tariffs and so forth in terms of the economy.
An old colleague of ours, Lou Schizas, used to say, there's much wisdom in a stock price. It reflects a lot of smart people are betting that the stock is worth that. And so you say investors, by bidding up the big Mag 7, are acting entirely rationally.
Correct. It doesn't surprise me. I know I heard you earlier say, Andy, that a lot of people come on your show and say, oh, the equal weight, it's time to outperform, et cetera, et cetera. Well, the reality is that what companies are doing the best in the S&P, it's the biggest 7. The only stock that hasn't reported is NVIDIA. All the rest of them beat numbers, and numbers went up. So I think the investors are acting entirely rational by buying further the biggest of the big companies because they are producing the best results. So I don't think it would be smart to move from cap weighted, which emphasizes the large company, to equal weighted, because the equal weighted companies across the board are not doing as well as the very big companies.
We've so little time. I wish we had more with you. One stock on your radar is LVMH, Moet Hennessy. Of course, people worried about Chinese demand and the impact on luxury goods may be prompted to sell the company. Do you think it looks like decent value right now?
Well, I mean, I highlight this, Andy, as an example of a stock that traded, 2 years ago at a mid-20s multiple. and the stock came down because of weakness in China, and it looked like a good deal because the multiple had dropped significantly. But the problem is that the E, that denominator, turns out has still been too high because their weakness in China has not turned. And so ultimately, what looked like a good company, it's a great company at a discount valuation, unfortunately, it hasn't been as much of a discount as people thought because the E is too high. So I don't think there's a commentary on LVMH. I think it's a great company, but until we see a turn in the Chinese high-end consumer, I think all these luxury companies are going to have a tough time producing good results. And that's what drives stock prices ultimately is better than expected, results. That's how you make money in stocks.
And you did not buy it because it looked cheap. That's interesting. We're having trouble with the chart for that one. Sorry. Here's the chart we do have. NVIDIA, it's the last of the Mag 7 companies to report. What are your thoughts on NVDA?
Well, I always get nervous, Andy, when you have a stock that's been very strong going into earnings season, because that means expectations are very, very high, and it's done very well recently. And so I wouldn't be surprised if, the bears point to something in the quarterly report that is negative. But when I take a step back, and it's the reverse of the LVMH, which is the stock looks expensive, but the problem is Wall Street analysts keep raising their earnings expectations. So the stock never is in reality as expensive as the PE because the earnings, they keep exceeding. And we've had a series of big companies that have tried to develop their own chips that have thrown in the towel and said, we're going back to ordering NVIDIA chips recently. And yes, I understand the U.S. is taking a 15% tariff on H20 chips into China. But don't forget, NVIDIA wrote off their entire H20 inventory. So 85% is better than zero. So I think there are positives that they can talk about. But anytime, this is true always as a portfolio manager, I think about when companies are about to report and how they've done recently. And maybe it's worthwhile taking a few chips off the table, but I certainly wouldn't get out of NVIDIA.
Andrew, thank you very much indeed. I hope you come back soon. Really appreciate it.
Take care.
Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management.